All right, good morning, trade pros. Welcome to Morning Market Update for this beautiful Monday, March 23rd of 2020. This is George Papsoff, Trade Pro Academy. Hope you guys have had a spectacular weekend. All right, with you and your families. Let me just line up the camera properly. All right, here I am. Huge news this morning causing a lot of volatility in the markets. And, it's going to be fun today. There's going to be some upside and downside. It's going to be a bit of a fight, but it looks like the bulls are back out, at least this morning, due to the Fed. So let's talk about this. First and foremost, the market was down earlier this morning, up to about 8 a.m. In fact, overnight it hit a 5% limit down, which was a circuit breaker once again. All right, this was on news that the Senate vote on the coronavirus package had failed overnight, didn't have enough support. It was a 47-47 vote, and it needed 60, so it didn't pass over the weekend. All right, it was a 1.8 trillion package. Chuck Schumer said that it's a large corporate bailout with no protections for workers and virtually no oversight. So he didn't like it. At 8 a.m., the Fed didn't mess around and they took action of their own because they knew that the market could really be in for a big tailspin if the market didn't step or the Fed didn't step in. So the Fed stepped in a big way. They announced they're going to be buying $75 billion of treasury purchases every day of this week alone. All right, and they also announced that they're going to be purchasing $50 billion of mortgage-backed securities on a daily basis. That's a $625 billion weekly package. To put that in perspective for you, in 2009, QE1 was $800 billion Troubled Asset Relief Program, or TARP. All right? So if you think about it, we just dumped an entire amount of liquidity that we did in 08 or 09 rather at the market bottom. So that's 375 in treasuries being purchased this week and 250 billion in mortgage-backed securities. That is a massive program. In addition to that, though, the Fed launched other stuff the market got excited about. If it was just bonds and mortgage-backed security purchases, I don't think the market's off the lows this strong. But here's what else it did. All right, I'm going to read a lot of this to you. I'm sorry, I'm going to have to read the screen. I can't paraphrase all this. They launched like 5 different facilities this morning. The first one they launched was $300 billion in new financing to employers, all right, consumers and businesses. For large employers, they've established the primary market corporate credit facility, PMCCF, all right, for new bond and loan issuance, and the secondary market corporate credit facility, SMCCF, to provide liquidity to outstanding corporate bonds. So the Fed is stepping in to protect the corporate bond market. Corporations who are issuing debt are going to have the backstop of the Fed, or $300 billion extra in liquidity, which is vital in this time of shortage of cash flow. All right, there's a shortage of dollars. In addition to that, they've established the Term Asset-Backed Securities Loan Facility, TALF for short, to support the flow of credit to consumers and businesses. And they've expanded the Money Market Mutual Fund Liquidity Facility, MMLF, to include a wider range of securities, including municipal, variable rate, and bank certificates of deposit. So they're backstopping the money market funds that they announced it would last week to a larger degree. That's new information. They're also expanding their commercial paper funding facility, CPFF, all right, and they're soon going to announce a Main Street business lending program to support lending to eligible SMEs, small business enterprises, basically. All right, they basically just threw the kitchen sink at the market. They threw everything they got. That's a huge bazooka shot this morning, and obviously the market's rallied almost 200 points off the lows. It's unique in that this time around, the market responded favorably to the Fed. But think about this. Fed cut 50 basis points March 3rd. Market dumps. Fed cuts 1% in addition to that, and a surprise cut last Sunday. The market dumps. All right? Yesterday at 6 p.m. when the futures market opened and we're down 5% within 5 minutes on limit down, all right, the Fed panics. And at this point says, all right, the government's not passing anything. It's our time to launch a little bit of a surprise into the market. So there you go. These free markets are being propped up. I think this is a good thing. All right. I do think we pull all the stops out and hold this thing up because we're having a historic market crash. Never has the market dropped this much in such a short period of time. All right. Also, at 8:35 in the morning, Treasury Secretary Steve Mnuchin jumps in and starts jawboning the market as well. And he says that all we want are small businesses to keep employees on and take government loans. He told Congress that they need additional tools to fight this ASAP. They're concerned that if businesses see lower revenue, all right, to send their employees home and essentially lay off the workforce, which causes a massive long-term implication for the economy as a whole. All right, I asked this question in Market Analysis Live the other day. We're told, and somebody posted this in Discord. I like this idea. I think this might have been Jerome. Jerome, this might be your post. There was a guy that tweeted something very interesting. He said, we're told to have 3 months of emergency cash flow, all right, in our any courses, any knowledge, any information that we're taught in finance, have an emergency fund of at least 3 months of savings. Businesses are going out of business in just 2 to 3 weeks of decreased demand, all right? There was a problem there to begin with. But anywho, Mnuchin says he wants assistance for airlines, but he wants them on market terms, meaning that he wants to buy some stakes of equities or to provide loans with interest rates. So it's not an outright bailout. It is support, but they're expecting some profit returns. Hang on, this guy's really going off in my ear. I gotta mute this for a second. He is saying good stuff, but I'm gonna have to mute you otherwise. So I'm gonna mute him. Okay, it's a squawk in my news that is reading a lot of this news that's taking place. All right. In addition to this, he said that the legislation prepares for a 10 to 12 week period during COVID-19. He said G7 and G20 leaders are working closely together with the IMF and World Bank for coordinated response. And so here's the thing. Airlines are looking for a $50 billion bailout. Will they get it? We don't know. There is going to be a vote today for this $1.8 trillion package in the government on Congress, and we're going to have a look at what happens here. It's going to be very important. Stick to the newswire today. You might get a huge event taking place if this vote goes through. The market may rally. So far, markets are off their lows overnight. Here's the thing, though. Tiger, the idea is to save both. Right? I know that we in society say, look, there's these elite CEOs and higher being humans, and then there's just the workers that work for them. But I don't think that's fair personally. I think that at the end of the day, we're all people, we're all humans, and these elite CEOs, if you will, yes, they get paid more, but it's a tough job too, right? It's one of the hardest things to run a business, and so if you put jobs on the curve of risk to reward, it seems extremely unrisky to be a CEO and get paid $6-7 million a year, but at the same time, you're away from your home 250 days out of the year. If you're a multinational conglomerate type CEO, you absolutely are spending more times in hotels. All right, so what is it worth? How much would it take for you to get bought out of time with your family? All right, in addition to that, if they get fired and they don't get rehired, you're paying them this amount of money, but then that stops. All right, and then there's taxation, etc. So I think that we need to look at this as a whole rather than split it up into two. I don't want to deep dive too much into that. I agree, the CEO paycheck compared to the regular person or your average person, we're all the same. We're all the average person. All right. It's a lot higher. It has grown, all right, but the valuation of these companies have grown as well. So I think the problem arises here that we've had a Federal Reserve that's blown up asset valuations since 2009 who hasn't gotten out. And that's transpired into creating an income diversity, all right, or the wealth gap has stretched out. That's to be expected, but that's not the CEO's fault. That's the Fed's fault. The Fed needs to take ownership for that. They had a chance to get it in 2011 and didn't. Anywho, so since February 20th, we hit a high of 33.97 half. Right? Now, I always tell you guys market crash from highs, never from lows. And we were 2.5 points away from 3,400 even. In my career, I've seen this so many times. We've had 5, 6, 7%. This one's 36%. So it's a pretty large magnitude drop off of failing 2.5 point even levels. So I always tell you, take profit right before juicy levels, not at them. Never take profit at juicy levels. All right, so we're down 36% since February 20th of this year. All right, in 29 calendar days and 21 market days, we've shed 36% of the value of the stock market. Clearly, there are issues with the stock market. All right, the economy though hasn't been on a 400% rally since 2009. So we're just catching down to the actual value. We've been overstretched in the market. We're giving back some of the gains to get back to fair value, if you will. All right. Here's the thing, though. We're down 36%. How many percent will it take to recover this sell-off? 56. All right. Remember this. If you lose half of your account, you got to double it up to get back to break even. So we need a 56% gain. Have a look at this. In 1987, markets were down 36% on Black Monday. and a 2-month decline. All right, so it took 2 months to drop 36%, double, and that was the most severe sell-off. And then it took 22 months to recover from that bottom. In 01 and 02, we were 38% decline from the top on a 33-month window, almost 3 years down 38%. And it took 48 months to recover. All right. In 2007 and 8, we had a 54% drop from the top in the market. Right, we lost half the value in 17 months, a year and a half almost, and it took 48 months to recover. All right, so judging by this, on average, takes about 30 minutes or 30 months for a recovery. Will the recovery be faster? Maybe, but I still think that we're in a new normal. It's going to take longer to recover. So yes, markets are bouncing on the stimulus this morning before the market opens, but I think the lows aren't in yet. I think we see a little bit more downside. I hate to say it. I think we're going to wipe out all these Fed announcement gains. If we do have a $1.8 trillion package approved today, the market will rally. All right, it will hit some overhead resistance, 2,400, 2,500 maybe, but these are still to be considered bear market rallies. We see some higher volume coming in. All right, and I still think we have some more downside. We need to see higher volume. We're not seeing it. Sell rallies at this point. And I think new lows are coming in until this coronavirus situation takes a turn. Okay, the Fed is literally wasting, or not wasting, but spitting all these bullets out, and there isn't even an animal in sight. They're hunting, and they're just hitting trees at the moment. It's not going to solve the coronavirus situation. This is the fear at the moment that's putting this downside. It's not the reason the stock market's dropping, but it's the reason propelling people to sell. They already had the idea to sell. November, I was buying books on the Great Depression, 1987 Black Monday, Bretton Woods gold standard. I wanted to read up in this stuff. I anticipated in 2020 we're going to get a major sell-off. I didn't anticipate it to be this quick, okay? And it never happens when you expect it, and it always happens faster than you expect it. That's the market for you, all right? Overnight, equities were down. They've since recovered. Crude oil is positive. All right, Bitcoin was down 7%. It too has recovered a little bit. On today's calendar, there isn't really much in terms of economic news. Just keep an eye out on the news squawk. You will be hearing more from government, from Congress, see if this deal gets approved. All right now we got quite a bit of a bid. Overnight high was set on the S&P 500. Where did we set it at? I think we are on June futures now. 23.55 looked like the overnight high, and down we go so far, 40 points or so. We are still about 100 and what was the overnight low? Overnight low was 22 something. We hit the limit down. So we're up about 150 points off those lows. So let's see. I think sell rally is the way to go early on until we get to see a little bit more of a bid. This bid was put in by the Fed, but remember, when the Fed cut 50 basis points, we rallied 100 points almost, 90 something, in literally a minute and a half. And then that thing sold off and hit new lows on the same day. Very big test for equities today. If we can hold these lows and we keep rallying, we might be in for a little bit of bear market run upward. All right. Love you guys. Be safe. Be careful in this market. I'm sorry I didn't get a chance to answer your questions as much, but we are running a daily trading room that's being broadcasted into as well. So put that in the comment box if you have a question. We'll answer it a little bit later on. Right now, we're going over to the oil desk. We're getting ready for the U.S. Open in our trading floor. We love you guys. Take care and goodbye. Boxy, over to you, kind sir.